Listen up because this is important. Options trading can be your ticket to big wins in the stock market, but it's not for the faint of heart. You need to understand the game before you play it. So, what exactly are options? Options are like contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a specific price by a specific date. Think of it like putting a down payment on a car. You have the option to buy it later at an agreed-upon price. Now there are two main types of options: call options and put options. Call options are like bullish bets. You're hoping the price of the underlying asset will go up. Put options, on the other hand, are like bearish bets. You're hoping the price will go down. Remember, options trading is a powerful tool, but it can be risky if you don't know what you're doing. That's why it's crucial to start slow, learn the ropes, and gradually dip your toes into the exciting world of options trading. Alright, let's break down call options. Remember that car example? Think of a call option as buying the right to buy a stock at a certain price, the strike price, within a certain time frame. Let's say you're bullish on Apple and its stock is trading at $150. You buy a call option with a strike price of $160, expiring in a month. This means you have the right, but not the obligation, to buy Apple stock at $160 anytime within the next month. Now, if Apple's stock price goes up to $170 before your option expires, congratulations. You can exercise your option and buy the stock at $160, then sell it immediately for a $10 profit per share. But here's the catch. If Apple's stock price stays below $160, your option expires worthless, and you lose the premium you paid for it. Remember, call options are profitable when the underlying asset's price goes up. The higher it goes, the bigger your potential profit. Now, let's talk about put options. These are your friends when you're feeling bearish about a particular stock or the overall market. Think of a put option as the right to sell a stock at a certain price, the strike price, by a specific date. Let's say you believe Tesla stock is headed for a dip. It's currently trading at $250, and you buy a put option with a strike price of $240, expiring in a month. If your hunch is right, and Tesla's stock price drops to $230 before the expiry date, you're in luck. You can exercise your put option, sell your Tesla shares at $240, and pocket a tidy profit. But remember, just like with call options, if the stock price doesn't move in your favor, in this case, if Tesla stays above $240, your option will expire worthless, and you'll lose your premium. Remember, put options can help you profit from market downturns, but they come with their own set of risks. Now that you understand the basics of call and put options, let's talk about two crucial terms: strike price and premium. The strike price is the price at which you have the right to buy or sell the underlying asset when you exercise your option. It's like setting a target price for yourself. The premium, on the other hand, is the price you pay to buy an option contract. It's like an insurance premium. You're paying for the right to potentially profit from price movements in the underlying asset. Think of it this way: the strike price is your target, and the premium is the cost of taking the shot. The closer your strike price is to the current market price of the underlying asset, and the longer the time until expiration, the higher the premium you'll have to pay. Remember, understanding strike price and premium is crucial for making informed decisions when trading options. Don't jump into a trade without knowing exactly what you're paying for and what your potential profit or loss could be. Section 5. Basic Option Strategies for Beginners. Alright, rookie traders, ready to dip your toes into the options pool? Let's start with some basic strategies that are relatively low risk and easy to understand. First, we have the covered call. This strategy involves selling call options on a stock you already own. It's a great way to generate income from your existing holdings. Next up is the cash-secured put. This strategy involves selling put options on a stock you'd like to own at a lower price. If the stock price stays above the strike price, you keep the premium. If it falls below, you buy the stock at the strike price. Then, there's the long call. This is a simple, bullish strategy where you buy a call option if you expect the underlying asset's price to rise. Lastly, we have the long put. This is a simple bearish strategy where you buy a put option if you expect the underlying asset's price to fall. Remember, these basic strategies are a great starting point, but it's crucial to do your research, understand the risks involved, and never invest more than you can afford to lose. Section 6. Advanced Option Strategies, Leveling Up Your Trading Game. Ready to take your options trading to the next level? Once you've mastered the basics, you can explore more advanced strategies that offer higher profit potential, but also come with increased risk. First, let's talk about straddles and strangles. These strategies involve buying or selling both call and put options with the same expiration date but different strike prices. They're great for profiting from volatility, regardless of the direction of the price movement. Next up, we have iron condors. This strategy involves selling out-of-the-money call and put options, and buying further out-of-the-money call and put options with the same expiration date. It's a limited risk, limited reward strategy that profits from low volatility. Then, there's butterfly spreads. This strategy involves buying and selling options at 3 different strike prices with the same expiration date. It's a neutral strategy that profits if the underlying asset's price stays within a specific range. Remember, advanced option strategies can be complex and risky, so it's crucial to have a solid understanding of options trading before attempting them. Consider consulting with a financial advisor and paper trading before risking real money. Section 7. Decoding Option Greeks, Your Guide to Risk Assessment. Listen up, traders. Option Greeks might sound like characters from a Greek tragedy, but they're actually your secret weapon for assessing and managing risk in options trading. Think of them as risk indicators that tell you how sensitive an options price is to various factors. First, we have delta. Delta measures how much an options price is expected to move for every $1 change in the underlying asset's price. It's like a speedometer for your options trades. Next, there's gamma. Gamma measures how quickly delta changes. It tells you how much your delta will change for every $1 move in the underlying asset's price. Think of it as the acceleration of your options trades. Then we have theta. Theta, also known as time decay, measures how much an option's value declines over time. It's like a ticking time bomb for your options trades, as the value of your options erodes as they get closer to expiration. Next up is vega. Vega measures how much an option's price is expected to change for every 1% change in implied volatility. It tells you how sensitive your options trades are to changes in the market's expectation of future price movements. Lastly, there's rho. Rho measures how much an option's price is expected to change for every 1% change in interest rates. It's usually the least significant of the Greeks, but it can still impact your options trades, especially for longer-term options. Remember, understanding and monitoring option Greeks can help you make more informed trading decisions and manage your risk effectively. Section 8. Risks and Considerations in Options Trading. Listen up, because this is important. Options trading can be a lucrative endeavor, but it's not without its risks. Before you jump into the world of options, there are a few key risks and considerations to keep in mind. First, there's the limited time frame. Options contracts have an expiration date, which means time is literally money. If the underlying asset doesn't move in your favor within the specified time frame, your option could expire worthless, and you'll lose your entire investment. Next, we have the potential for unlimited loss. With some option strategies, like selling naked call options, your potential for loss is unlimited. That's because the price of the underlying asset can theoretically rise indefinitely. Then there's complex strategies. Options trading offers a wide range of strategies, some of which can be quite complex and difficult to understand for beginners. It's crucial to thoroughly research and understand any strategy before implementing it with real money. Psychological factors are also a big consideration. Options trading can be emotionally charged, and it's easy to get caught up in the heat of the moment. Fear and greed can cloud your judgment and lead to poor decision-making. Lastly, there's margin requirements. Options trading often requires margin, which means you're essentially borrowing money from your broker to amplify your trades. While this can magnify your profits, it can also magnify your losses. Remember, options trading is not for everyone. It's crucial to carefully consider your risk tolerance, investment goals, and financial situation before diving in. Always start small, educate yourself thoroughly, and never invest more than you can afford to lose. Section 9. Popular platforms for options trading. Ready to start trading options? Here are a few popular platforms that offer a user-friendly interface, advanced trading tools, and a wide range of options contracts to choose from. First up, we have Thinkorswim by TD Ameritrade. Known for its robust trading platform, thinkorswim offers a comprehensive suite of tools, including advanced charting, technical analysis indicators, and paper trading capabilities. Next, there's Interactive Brokers Trader Workstation, or IBKR TWS. Popular among professional traders, IBKR TWS provides access to a vast selection of global markets, low commissions, and advanced order types. Then we have Tastyworks. Designed specifically for options traders, Tastyworks offers a streamlined interface, intuitive options chains, and a focus on options-centric education and tools. Next is E*Trade, a well-established online brokerage. E*Trade offers a user-friendly platform, a wide range of investment options, and access to research and educational resources. Lastly, there's Fidelity. Known for its strong research capabilities and customer service, Fidelity provides a comprehensive trading platform, a wide selection of options contracts, and access to educational resources. Remember, when choosing an options trading platform, consider factors such as ease of use, research and educational resources, trading tools, commissions and fees, and customer support.